Welcome back, everyone. This is the 11th part of our series where we're solving the UP PGT Economics 2010 paper. Today, we're going to get into the next 10 questions, which are mostly about international economics and a few really important financial institutions. Okay, let's dive right in.
So, our first section is going to focus on international economics. We'll be looking at some key questions related to trade, exchange rates, and the balance of payments. Some really foundational stuff here.
All right, first question up. It's about a super fundamental theory of exchange rates, purchasing power parity. So, who came up with this theory?
And the correct answer is G. Cassell.
So, what's this theory all about? Well, G. Cassell's purchasing power parity theory basically says that the exchange rate between two countries should, in the long run, equal the ratio of their price levels for a fixed basket of goods. In simpler terms, a cup of coffee should cost the same in India and the US, once you account for the exchange rate. That's the core idea.
Okay, let's move on to our next question. This one's on devaluation, a really popular topic for exams. The question asks, if the demand elasticity for both exports and imports is exactly 1, what happens to the balance of payments after devaluation? In this specific case, the balance of payments will be completely unaffected. Now, why is that? The reason lies in something called the Marshall-Lerner condition. It's a rule of thumb that tells us when a devaluation will actually work. It says that if the sum of the elasticities of demand for exports and imports is greater than 1, things will improve. If it's less than 1, things get worse. And if it's exactly equal to 1, well, nothing changes. The situation remains unchanged. This next question is about a very important concept related to the IMF, the SDR, or special drawing right. You have to pick the statement that is not true about SDRs. The incorrect statement here is option C. You see, SDRs are not easily transferable like regular currency. They are an international reserve asset created by the IMF. It acts as a unit of account, it's often called paper gold, and yes, member countries do pay interest on its use. But its transfer is heavily regulated by the IMF's own rules. Let's bring it closer to home now with a question about India's own exchange rate policy. What do we call the foreign exchange rate system that India currently follows? India follows what's known as a managed floating rate system. So what does that actually mean? Well, it means our exchange rate floats, so it's determined by market forces of demand and supply. But, and this is the key part, it's also managed. Whenever there's too much volatility, big swings up or down, the RBI steps in. It'll buy or sell foreign currency to stabilize the rupee. It's a bit of a hybrid system. Next up, we've got a direct question on the definition of terms of trade. What does this concept specify? And the correct answer is, it's the ratio between a country's export prices and its import prices. We often show it as PX divided by PM, where PX is the price index of exports, and PM is the price index of imports. Basically, it tells you how many units of imports you can get for 1 unit of your exports. So if your terms of trade improve, that's generally a very good thing for the country's economy. This question is about the concept of an optimum tariff. So what exactly is an optimum tariff? An optimum tariff is one that maximizes the net benefit for the country that's imposing it. See, here's the thing about tariffs. They have 2 effects. There's a positive one, where they can improve your terms of trade, but there's also a negative one, where they reduce the overall volume of trade. An optimum tariff is that sweet spot where the positive effect is at its greatest compared to the negative effect, maximizing the country's overall welfare. And for the final question in this section, it's about the difference between 2 very important concepts. The trade balance, what kind of imports and exports does it include? The correct answer is only visible items, physical goods that you can actually see and touch. It's really important not to confuse this with the balance of payments. The trade balance is a narrow concept, just looking at goods. The balance of payments is the big picture. It's a much broader concept that includes everything. Goods, services, capital, transfers, the whole shebang. All right, let's switch gears a bit. Now we're going to tackle a few fact-based questions about some very important financial institutions. First up, a question about a major regional development bank. Where is the headquarters of the Asian Development Bank, or ADB? Its headquarters is in Manila, in the Philippines. It was established way back in 1966. It's a multilateral development finance institution with 68 member countries. These are definitely the key facts you'll want to remember about the ADB for your exam. Next question. This one's from the history of rural banking in India.
When was the first regional rural bank, or RRB, established?
The first RRBs were established on October 2nd, 1975. The whole point was to extend banking facilities to people in remote rural areas. They started with just 5 banks in the beginning.
And for the last question in today's explainer, it's about a microfinance fund. Who operates the Microfinance Development and Equity Fund?
The correct answer here is A, NABARD. This fund is operated by the National Bank for Agriculture and Rural Development, which, as you probably know, is the apex institution for all rural and agricultural finance in India.
Okay, so let's do a quick recap of the most important concepts we covered in today's session. These 4 concepts are absolutely critical. You have PPP for exchange rates, the Marshall-Lerner condition for devaluation, India's managed floating system, and of course, the difference between the trade balance and the BOP. Make sure you've got a solid handle on all of these.
And that leaves us with a final thought to chew on. How can a really deep understanding of these international and financial concepts help us come up with better solutions for our country's current economic challenges? It's something to think about. We'll see you in the next part.